Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Well, okay, Bob, let's just kind of move back into it. For those who haven't watched the introductory show, I suggest you go back and do that because you'll want to get the background on Bob before we get into this particular show, which is a deep dive really on walk-forward analysis. I guess, Bob, can we go back and just do a really quick summary of what walk-forward analysis is, just to kick us off again, I suppose?
Okay, well, walk-forward analysis basically is a collection of individual walk-forwards. A walk-forward consists of looking at a chunk of historical data and optimizing your parameters, picking the best one from that optimization, and then adding a period of data at the end of that and seeing how it does on that out of sample data. So you have the in-sample window and the out-of-sample window. Usually the in-sample window is considerably bigger than the out-of-sample window. So then what you have, you can do one walk forward, but certainly experience has shown me that one walk forward, you can't really hang your hat on one walk forward. Let's put it that way. There's all kinds of reasons why one walk forward can be successful and not really mean that the strategy really is all that robust. So what a walk forward analysis actually is a series of walk forwards. So if you're going to look at data for a 20-year time period, you get your time machine, you optimize your data on the first 3 years of data, then test it on the next 6 months, and then you record both of those results, but you're really focusing on the results of the out-of-sample window. Then you move the whole thing forward 6 months, the length of the out-of-sample window, re-optimize, pick the best parameters, and trade it on the next 6 months. And you do that whole thing until you've gone through the entire test period, and collect the results of all of the out-of-sample windows to make a judgment as to whether your strategy is robust. Because obviously, if it's not robust, the results of the out-of-sample windows it will show. Let's put it that way. So, but what I think one of the most important factors is that people tend to ignore is that the statistics you get from the walk-forward analysis are a lot more accurate than the statistics you get from just doing a regular optimization.
Yeah, right. I think from what I've been gathering, chatting with you, what's standing out to me is that walk-forward analysis is all about obviously creating robust trading strategies. It's the solution, if you like, to avoiding overfitting.
That's true. The lazy man's way of doing it.
Yeah. And I think one of the other real advantages I'm picking up on is that, it's a way of systematically building strategies that are updated for current conditions, because by definition, built into the process is this, this re-optimization around more recent data. Are there any, if you were to talk about the advantages of or the pros and cons of walk-forward analysis, what comes to mind?
Well, I think that the adaptability, which you would just describe so nicely, that's one of the biggest advantages of it. It's a much more realistic way of looking at a trading strategy and how people actually apply them. And the biggest advantage is that you've got something that actually you can count on. People, I can't overestimate that enough. People just, when you don't use walk-forward analysis or when you don't use walk-forward analysis or something that might offer a simple benefit or similar benefit, you really don't know whether you really have a strategy or not. I don't, like I said last time, just because you come up with a strategy that optimizes well on TradeStation, assuming you're actually doing correct optimization, which is not always a valid assumption. But let's assume you actually are doing correct optimization. It's still no guarantee you actually have a strategy that actually is robust. There's all kinds of reasons why it might not be. But by simply doing a walk forward analysis, the reason why I say it's the lazy man solution is you can do a walk forward analysis very, very quickly, and see whether you really have something. You can run an enhanced walk forward optimizer in a matter of, 1 minute, 2 minutes, 3 minutes, and if you but if you don't do a walk forward analysis, in my opinion, you don't have an idea. You haven't got a clue as to whether or not your strategy has a chance of making money going forward.
So a couple of questions at the outset before I really, push and probe and get into my kind of questions or common objections and things like that. Are there some key markets that are best suited to walk forward analysis and certain markets that are not?
No. I mean, I don't. I haven't spent a lot of time working on currencies, per se. I haven't, but I've spent some time with it, and I haven't spent a great deal of time working with stocks. But it works in all of them. So, I mean, I think the one thing, walk forward analysis is not going to work in any market which is really basically not moving. I mean, but then no strategy really will. So I think but in terms of actual classes of markets, I don't think it matters. I think, it's again, the same criteria you apply to whether you trade a market would apply to whether you want, or whether or not you want to run a walk forward on it. Because if a market is really, really illiquid, and has, huge spreads, and really poor executions, very poor liquidity, so you really can't do any. You can't do more than 3 contracts or whatever. It's the same kind of stuff. You don't really want a market you wouldn't want to trade in. A market in which you wouldn't really want to trade. Probably you may get good results in walk forward analysis, but you're not going to get something you really want to trade.
So, one of the things I've been thinking about as well is just the art versus the science, if you like, of building strategies, right? So, the feeling I've been getting is that there's still a certain amount of art in this process. And I'm thinking specifically around the fact that one still has to analyze the output of the walk forward analysis in a certain way and to still decide whether or not to kind of pass it or fail it, to trade it or discard it. And I can see that potentially the influence is going to be there to fix a problem, go back, run the thing again, and walk back into that same problem of just overfitting. Is there a process that you've really defined that really makes it a lot more hard science, if you like, or do you feel like there's a lot of experience that actually comes into building and assessing the results, and that's something that that's a muscle you've got to build up over time?
Well, there's a little bit of art or judgment in it, only because it hasn't been quantified yet. Let's put it that way. What you want to know in a walk forward analysis, for example, is that and I talk about it in my book. I mean, you want to really know that you're not really, you don't have any real extremes. You didn't make all your money in one period, or you didn't make all your money in 2 trades, or ideally what you want to see is the same performance in every window. That doesn't happen. But you're always looking for consistency of performance. So that can all be quantified.
Right, but if you don't get that on the first run, you could go back and have a few light bulb moments, change a few things, try again. What's the difference between just exploring and using that process to build the strategy and learn how the markets are moving versus just going down the overfitting path again?
The difference is, the ultimate example of curve fitting comes in when a guy, like we talked about before, a guy looks, he sees that there's this thing got killed because it had 2 really, really poor big trades, and it comes up with some very specific rule. Even worse, it comes up with a rule to get rid of the one, and another rule to get rid of the other one. That's curve fitting. In our standard process, we run a batch of strategies based upon the different kinds of classes of strategies that are in range or across. And so when we want to look at a target, we don't scan the target for every individual walk forward, and we don't scan a different target for every different strategy. We look at all the strategies with that target and risk stop. And if we want to look at a different target and risk stop, we look at all the strategies with that risk stop or target. And even then, you want to see that, in fact, because our reports show us the performance on an individual basis, then on a class basis, then on a total basis. So what you want to see is the whole thing get better. What is more along the lines, and it's not even as bad as curve fitting, but what you don't want to do is say that you run this target and you see that the one strategy out of 30 is actually way better than it was with another target. And then the other target might have had everything looking pretty good, but this one looks great and the other ones look poor. Well, that's not what you're looking for. You're looking to see that all the strategies perform on average better, not just one kind. And you could, for example, like in our case, we have counter trend, with trend neutral, and we have different subsections within that. It's not entirely out of the realm of good practice if we find that one particular sector is outperforming with certain kinds of targets. I suppose that's where an element of the art or the experience comes into it. If I know, for example, that a counter trend strategy might work better with this kind of target, or the short might work better with this kind of target. This is from experience. But what you're looking for is consistent performance overall, not just in one particular strategy or one particular year or one. The more narrow the spike performance is, the more likely you have an aberration than you actually have an actual something you can actually count on. Does that make sense?
Yeah, it does. So it leads into, I guess, strategy suitability and a question around whether there are types of strategies that are more suited to walk-forward analysis. But let me just clarify, because I know you'll want to say can work anywhere to some extent, but there are very slow, long-term trend-following futures traders, and there are very high-frequency intraday traders. I can imagine scenarios with longer-term trend following where you would just have a very small sample size. You may really want access to all the data all the time just to have that sample size. Are there particular strategies in your experience that, that this kind of process tends to output and tends to work better on?
In the same kind of way that you're always wanting to have more bigger sample than a smaller sample. Yes, when you have a very slow trading strategy, that presents its own kind of complications. We have a strategy that was in Renaissance that was based upon a pattern that I discovered in one of a pattern that I discovered, and it was it didn't trade a lot, but the logic behind the pattern was something I was very, very comfortable with, and that it also didn't trade a lot was something I was relatively comfortable with. So I was, with strategies like that, you kind of always have to think to yourself, well, okay, let's put this one on a shorter fuse, because maybe it really isn't what I'd like to think that it is. But it doesn't preclude the fact that one of the things you would do, and one of the things that we've done, is we look at a shorter time frame to get a bigger sample. This one was originally built on 60-minute bars. I wouldn't have confidence, for example, in working it on daily data, because I think I'd have to look at maybe 20 or 30 years of data to have confidence.
Yeah,
So you have to
exactly.
kind of, in the end, if you're going to have a small sample size, you have to do the best you can to get it as big as you can. And that isn't always possible, but when it is, you should do it. But the thing is, it's if the idea was kind of a sketchy idea to begin with, and you get a very small sample size, then you have to look and see whether or not it works in different time frames, whether or not it works in different kinds of markets. You're looking then to see you're getting your sample size up with higher frequency trading or more markets, because ultimately that becomes that. If you have a strategy that makes 3 trades in 5 years, um, you better have a good. They better be big, and you better have a good reason.
Yeah.
So it does come down to the issue of sample size, and ultimately, the frequency of trading really comes down to the preference of the trader. I mean, do you want to sit around and wait for 3 years for a trade? And I'm not. I don't trade for thrills like some people do, but you certainly want to have opportunities more. You might have more opportunities than them. It's kind of an issue of not even walk forward analysis, but whether or not you've got something you really want to trade anyway, even if it's good.
Yeah.
I mean, I had a customer who was a floor trader who had strategies that did that, and I don't know whether I honestly I didn't know him that well, and I didn't really know how effective he was as a trader. But he seemed to be okay with it. But he had a lot of strategies. It wasn't he just didn't have one. He said he had one that traded like every 2 years, but then he had like 40 or 50 different strategies that he used. So it becomes a matter of preference and style too.
So, you've got this process for assessing this walk forward before going live, and we'll get into that. But I presume you can use the same process for deciding then essentially when and if to retire a strategy. Like, would you use the same kind of metrics or some somewhat different metrics once you've gone live? And as you're rolling forward in these walk forwards going live, um, do you apply a certain metric to when to say roll that strategy off and another one in, or how would that work?
It's a different process. You look at a pool of strategies, and you have to have some kind of principle for picking the best ones.
Mm, yeah.
It's not dissimilar, but ultimately, I'm a great believer in always in really focusing your trading on what's really moving, and the strategies that are really performing.
A big picture kind of concern of mine again, and forgive my ignorance, but in listening to you so far, I get the kind of proving a strategy is robust through this principle. What I haven't heard a lot about is actually building the strategy initially, and I get that they're kind of one in the same, but I get the feeling also that there's, you've mentioned that explorative scientific approach, testing a lot of things and see what works, like Edison until he comes up with the light bulb. So in my thinking, one might take a bunch of data at the beginning of the test set, maybe more than normal, to kind of explore and build, what might be logical entries or stops or targets and things like that. That then you overlay, you build a strategy, and then you work out what the core drivers are of that strategy. And then you start this walk forward process to really optimize on a couple of the key drivers. And the reason why I put it like that is because if you were walk forwarding and just optimizing every possible thing in this scenario, in the strategy, you could end up with billions of permutations and basically a completely machine-led approach.
You're also likely to be curve fitting.
Yeah. And it's just completely machine learning then at that point, right? It's like just let the data come out like I'm really doing nothing. So what's the trader doing up front? Is there kind of like a strategy build process that happens first? I know, like, people like yourself you get a lot of experience in trading. So over time, we've all looked at the same data for many, many years, and we've looked at the same kinds of strategies. So we do get a feel for what works and what doesn't, for what works with one strategy type versus what doesn't. We know what '08 is going to deliver for a certain strategy type, and so on. So maybe we kind of tend to forget some of the building blocks. But is there a cause for spending time kind of building out and exploring the data to build key components of the strategy first, and then we overlay a few drivers, or we've got a few key aspects of that, and then we're going to walk forward on those? Is it kind of a two-part process, or am I just misstating that?
Well, I have so much stuff that I know works, that I don't really kind of have the same problem a lot of people might have, saying, why I have nothing that works. I don't know. I got to figure out something that does work. I have a lot of things from over the years that I know work. So more my issue was getting the resources to actually get them all into what I call production. But I can tell you that a couple of years ago, I was playing with a lot of ideas. I get off on these tangents, and I was playing with a couple of ideas that that they were good. They were good ideas. I mean, but they got to be they got to be complicated fast.
You went down some rabbit holes.
Yeah. Well, I mean, yeah. But the way I sort it out is I run a walk forward analysis on them, because that's the thing. I didn't really, I was playing with a lot of ideas to do with relative strength, because it's a great, as old as it is, it's actually really it's a pretty great indicator still. I mean, the stuff we use isn't based on relative strength, and we don't even use relative strength in it. Although actually I'm planning on adding it, because I have a use for it, that I want to, a particular use that would actually be very, very good for. I think these different variations of this relative strength strategy that I was building, I was simply because when you start looking at these things, you can rapidly, you look at it, you look on this, you look at the S&P, you look at soybeans, you look at this, you look at that, and it all looks good. But I don't really have that much confidence in just these little, what I would call, sketches. So I run, I set it up to look at all these different variations of the strategy, like we do with our other stuff, and I ran it through a walk forward matrix to see whether there's actually something there, or whether it was mostly just bullshit. And I found out that some of it was very, very good, and some of it was just, let's put it this way, it was not sufficiently well developed. So I didn't, and it really wasn't worth the time I would have to spend. I mean, I put it up for future reference. If I ever need something like that, I can dig that out and finish it off. But it is kind of a two-step process. The first one is you actually see whether or not it actually makes money at all. Because if it doesn't really make money in its first incarnation when you optimize it, it sure is not. It's not going to make money when you go any further. So you have to get the first step. But then I know from experience, because in all of part of our robustness testing is to simply when we run the optimization, it tells us how many of the instances in the optimization were profitable. And I know from experience that if 20% of them are profitable, odds are very, very good. It's sometimes they come out, but most of the time they don't. So, I mean, but I've done this for a long time, so I know this stuff. But ultimately, if, like I've said to you before, if you run a strategy and you run a test on it, and you have 1,000 parameters and all of them are great, you're done. But that doesn't happen in my experience, that doesn't happen too often. But a lot of our stuff, for example, will be in the 50%, 60%, 70% higher, sometimes higher, in terms of numbers of profitable parameter combinations. But even with that, for example, part of what you have to do when you look at an optimization is you can have 90% profitable, but the question really gets to be, I mean, are they all relatively in the same category, or are they all over the place? I mean, is one making $500,000 and one's making $3,000? You really have to. So that's part of what you have to. That's part of what you don't have to do if you do a walk forward analysis. Because if you're stuck with not doing that, then you really have to analyze this stuff. You have to analyze this stuff at a much more fine level of detail. So it's the first step has to be you have to get pretty good results in my book. And when we're doing stuff, if something doesn't really look really pretty good during an optimization, odds are I'm not going to bother taking it any further. So it's the first step is it all lives and dies with the first step. If that answers your question.
Yeah, but that first step is still not peaking at out of sample data.
No, well, sometimes I frequently frequently do look at a single. I'll frequently do it going back. If I'm doing this from something I know nothing about, I will actually make a point of leaving a little bit of a year or two of out of sample data and testing it on them, seeing how it goes.
Right. So I guess this leads me into assessing the robustness. And I'm thinking about the objective function. But as I lead into that, as we look at the, I guess, analysis of the walk forward test, where in each step, we're picking the best outcome to trade live. Now, this scares the heck out of me as soon as we put the word best in quotation marks. So that's just my lack of experience. And I presume that I would find ways to get a best, quote unquote, that I like. But in one sense, we've got this single optimal set at each stage, and to me that would be contrasted with saying that there are multiple sets that could work next year or next month. We don't know what they are. And it could be what we've just optimized, but it could be this selection in a range. So the way that I generally approach it at the moment is to try and trade all of them. Like, give me the variance in that range that I think are in that, robust plateau of parameters, and I'll throw them all at the market, and hopefully one of them will survive and the others won't do too bad. And I'll kind of average out my way forward. Is that also a valid approach? Can they be combined? Can you have this kind of ensemble approach of running multiple variants and also this walk forward approach?
The ensemble approach is fine, but but the thing is, obviously that doesn't work for everybody because it takes a bigger account size. I think the ensemble approach is actually not a bad idea at all, but I would rather it was, from my point of view, instead of having 10 flavors of one particular strategy, I would really rather have 10 different strategies, even if and a strategy wouldn't just be a difference in a strategy. Like, let's look at moving averages. Let's say you're looking at moving average of 2 by 5 by 10. Well, a strategy that looks at 1, 5 by 10 by 20, in my opinion, really isn't that different, although it's maybe different enough. So I would really rather come up with different strategies than just different flavors of the same strategy. But I think having 5 of the best parameters for a particular strategy is a good idea.
Mm.
There's value in that.
Okay, so we're running the walk forward optimization process, and we're selecting the quote unquote best set of parameters. How can we be the most confident that that best is itself not an outlier? So I would imagine also, for example, providing having some provisos in there, some filters, if you like. If I would want to manually review, or maybe systematically, if you've built this out, for example, the number of trades, it might have just spat out an out of sample period with 2 trades in it, and they were both enormous winners. But and it, for some reason, gave it the best objective function because I was just looking at net profit. But really isn't probably it was blind luck. It was stupid luck. So it's probably not the parameter set that I want. So there must be a lot of work that goes into
something here. There's a difference in having 2 trades in the in-sample period versus 2 trades that are profitable in the out-of-sample period.
What do you mean?
I think the 2 trades in the out-of-sample period count. The two trades in the in-sample period, if it were, let's say you're looking at a 3-year time period, and you only have 2 trades in the in-sample period, I would think that's probably not. Let's forget about it.
Right. So the example I'm giving is like I had 100 trades in the in-sample period. In the out-of-sample period, I only had 2 trades, but I had the biggest net profit. I'd want to put some serious thought into the objective function that took account of many factors, not just one. But how does that work out?
It's important. It's very. The tools that exist don't really provide very good objective. They don't provide very good objective functions. Well, let's put that. Let me back up. They don't provide, in my opinion, sufficient resolution to, analyzing the data to really be as good as I'd like them to be. Let's put it that way. But you will find, if you look in TradeStation, for example, in their walk forward optimizer, you can only use, I think, 7 different objective functions.
And you can't define your own.
Not in TradeStation. In Trader Studio you could. In something like Zaro you can. In multi-charts, I don't know if you can or not. I bet you maybe you can. I know you can in NinjaTrader. I think he told me you can do it in NinjaTrader. But I don't really think, in the end, I'm not going to go into, this gets to be highly proprietary, but in the end, I would say that, it's not proprietary to say that whether you use net P, I would, the last one that I would use by itself is just net P&L. I wouldn't use drawdown, for example, as a metric. P&L divided by drawdown. One of the things we use in TradeStation is they have something called correlation with perfect profit. Then perfect profit was what I invented and released in my book. And the correlation to perfect profit, it sounds great, but the truth is there's not that much difference in the results of that versus P&L divided by drawdown or rate of return or whatever. There's not that much variation with that. I don't think that the individual metrics by themselves will make that much difference. I think looking at it in a more complex way, like I said before, if you were able to judge the results of your in-sample the way a skilled trader would evaluate the performance of an equity curve, that would be valuable. That would be valuable. And you can't. Nothing that exists now lets you do that. That's the ideal world. Let's put it that way.
Yeah. I mean, given the tools available, is there scope to manually select, if one is very rules-based about it, to manually select the parameters in the out-of-sample period?
I mean, for every individual walk forward?
Yeah.
Well, good luck to that.
Yeah, okay.
I don't think so. Yeah. It's just you can do it manually. You could actually walk forward. I mean, I have done this where you actually do a walk forward manually, one step at a time. You could do that, but I don't think it's necessary. I mean, there are other tools that will let you do this in a more sophisticated way, and that's the avenue that I would choose.
Yeah. Okay. Yeah, because I'm thinking of an example where, parameter value 50 produces the best risk-adjusted return, and the next best is 100, and then the next best is 105, and the next best is 110. And everywhere around 50, 40 and 45 and 55 and 60, the results are terrible. Like, it just drops off the cliff. So I'm not selecting. I'd want to select the best that's on some stable plateau, if you like,
Sure.
for that particular. So I guess one has to design the system and the objective function around that, and principles like that.
Well, that would be funny you would mention it. We actually when we there's well there's a you're talking what we used to call a buddy check. So you're really looking to see whether or not you don't want the one that's like this and everything else is way down over here. That's a spike. You don't want that. You want the one that's on top of a hill, and there that's the kind of thing which when with 2 parameters or 3 parameters, that's not so difficult. With more, it gets to be more complicated math. But one of the things we did in our software years ago was we would have the ability to actually say we don't want just we don't if the best parameter is 5 by 10, we want to know that it's only the best if it's actually if 5 by 6, 5 by 7, 5 by 8, 5 by 9 all added together is better than something over here. And that can't be done in current software that I'm aware of. But that would be. I've talked with the people at SQX. They said that it could be done, but they don't do it yet. But they said it could be done. And Mark is a good programmer. I'm sure he can pretty much do any of this kind of stuff. I know he can do any of this kind of stuff. So, but it doesn't exist yet. But that is, you're right. You don't want the peak. You want the hill. And you can have one of the things you could actually you can if you really want to get this is the kind of thing you can visualize in Excel, but you can't really do it. I don't think any of the walk forward stuff lets you do that.
Yeah, so given the limitation on the technology out there at the moment, it sounds like one needs to be pretty prepared to use Excel quite a bit in addition to, say, a trade station, and or be building out some additional apps themselves.
Well, just be mindful of one thing. In the end, if your strategy really, in a way, you could say, for example, that if you have ultimately visualize in your mind an optimization space, and visualize one scenario where you got 1,000 combinations, and in that space you've got 7 or 8 spikes in there, and even the ones around the spikes are not bad, but the spikes are way better. Well, that's one option. That's not, or you could even be worse. You could have 7 spikes and you could have all garbage all around it, or you could have a situation where you have the whole thing is moving towards the hill. What tends to happen when you do a walk, if you do a walk forward analysis with a lot of walk forwards, is it's not going to really pass with good values unless you really have a pretty robust strategy that actually is producing a lot of hills in the optimization. Yeah. It's kind of self-filtering, and I don't want to oversell the concept, but that's what happens if you have a bunch of spiky optimizations. You're gonna get poor performance in the out of sample windows, and the overall walk forward is going to wind up failing or looking very poor. And if you come up with a walk forward that has good results overall, and when you look at it, you find that it's actually relatively consistent throughout. Its odds are that's the definition of a robust strategy. A robust strategy produces a lot of tradable strategies combinations. A feeble one does not do them. That's what curve. That's kind of like what the curve fitting stuff is.
Yeah, although some would say that for any given strategy, one should understand its strengths and weaknesses if I'm trading trend following, I know that the strengths could be the ability to create outsized returns at certain times, and the weaknesses could be that I should be aware there could be extended periods of drawdown. And for a different kind of strategy, there's going to be different strengths and weaknesses. So some would say that, given a certain period, like a long-only strategy in a sell-off, I expect it to do poorly. And if it doesn't, then maybe I've overfit it. So does one have to be mindful of the regimes that it's being filtered through at each time, and then not necessarily expecting consistency in every regime?
Yes, you can't. I mean, whether you optimize or do a walk forward analysis, it's always married to the data you build it on. So if you build it on a heavily biased sample of data, it's going to be married to the long. It's going to be married to a short sample based upon a big bull market. So it's always married to the underlying data. Period.
So it's important to run a walk forward over multiple regimes.
Well, ideally, yes, or be aware of the fact that if you have a long only strategy, you're you if it's long only, you're not going to. If it's long only, well, I guess a long only strategy still can get killed in a sell off. I never thought about that. Usually the stuff we do with the long only stuff won't really get involved with those. It won't really be buying. It's not too inclined to be buying, the falling market as it's falling. So you have to be. I mean, I guess you have to be aware of the fact that if if you had a long only strategy and you built it and you liked it, you should at least see what it did when the market sold off, because there's no you're going to have breaks in any kind of market. So you should be aware of the fact that whether it's going to get whacked or not, you should be aware of that, because it is. But again, I can't overemphasize that. It's any strategy you build is always married to the data on which it's built.
So I just want to ask about how you assess the performance, because again it's like this art and science, or it's art until it becomes science. Whether we're running a single optimization over an entire data set or doing a walk forward analysis, we've got to have some principles as to what we think constitute success and failure. What are some of the typical things that you're going to look at to determine whether the walk forward analysis shows the strategy is robust and it has passed or not?
Well, the first one is, did it make money overall? Obviously, and did it make enough money to be worthwhile? Number two, how does it look compared to its drawdown? It's not that different than assessing an overall optimization. You want to see how it did during the draw, what its drawdown looks like. You want to look at how many trades it has. You want to look at the size of the average trade. You want to look at the distribution. Probably one of the most important things you really want to look at once you start drilling into the walk forward itself is you want to see the distribution. Yeah, I'm at a point where I'm not really willing to. I'm not really crazy about, nor am I really willing to accept really infrequent trading strategies for all the obvious reasons.
Yeah.
But I'm not. I personally don't want them anymore. We had that. We had it with XT99, which made tons of money, but it had long periods of drawdown, which I really, having lived through them, I can tell you I don't want to.
No, they're no fun.
I'm too old to want to live through them anymore anyway. But I don't want to. If I were 20, I wouldn't want to live through them. So So with more frequency, you have more opportunity. You have quicker recovery from drawdowns. So, but you want to look at the consistency. You want to look, and the consistency means not just P&L, but consistency for P&L versus drawdown number, and consistency of trades throughout. You're looking for ultimately you want this kind of equity curve. You need to see that kind of performance in your walk forward. So you're in the end you're looking for performance. You're looking for whether the performance is enough to justify it. You're looking for its risk adjusted value. You're looking for we have a tool in our portfolio analyzer which actually would analyze the drawdowns, and I don't think that kind of thing exists, but it would be a very, very worthwhile tool to be able to actually analyze the drawdowns and see whether or not they're relatively consistent. So again, the biggest thing is performance and consistency. You also don't want, three walk forwards is better than only one walk forward, but 10 is better than 3, and 30 is better than 10. So the more walk forwards you have, the more each walk forward is kind of like an experiment. And so you also want to know most of the things that exist now, I don't think really do this, but we used to actually count the number of in sample windows and out of sample windows that were out of sample windows that were profitable. That's pretty important too, because you really don't want to see, like we said earlier, you don't want to see all your performance in only a couple of windows.
Okay, so that kind of leads into the window lengths. Are there certain ratios of in sample to out of sample that match with certain strategy types that kind of work best?
Well, I don't know that you could really say that there's any ratio really is particularly good for any particular kind of strategy. I think it's got more to do with the data than it's got to do with the strategy. But one of the things that we do, I mean, to some extent, it's one of the things I'm finding is with the more strategies we have, the more work it is. It's just a lot of work to keep all that stuff up to date. And we're going to automate that. So, because it's kind of like it should be automated anyway, but it's not. And so there's the issue of the window size has got to do with practical concerns. Like, do you want to be optimizing every week, or do you want to be optimizing every 3 months or whatever? So that's got something to do with it. But ultimately, I don't really I have a guy who approached me. He was having problems with his walk forward. And he was he's telling me he's looking at a window. His in sample is the same size as his out of sample. And I said, well, why'd you do that? And he said that he optimized it. I said, optimizing a walk forward window is the epitome of curve fitting. I would not. I really strongly urge you not to do that. But he's a young guy, and he's going to do what he wants to do. So I don't think what I told him it really registered. But in any case, I generally we will look at I wouldn't look at a ratio of the smallest we've looked at is maybe it's 9-1. So we'll look at 10% for the out of sample. We're looking. I also look at different kinds, but generally we don't go smaller than 10%. And we look at generally 20, 25, 30%. You can look at it that way. Ultimately, because there's nothing if you're inline, if you're doing an inline walk forward analysis, if your strategy is actually optimizing on the fly, which some people do, and it's all and the process is all completely automated. Well, then and if it's working, I suppose it doesn't really matter. But I think that ultimately, looking at 10 years versus a 1 month out of sample, that's just kind of silliness. So I know years ago, we talked about this before, when we were running XT99, Dumb was actually doing it 10 by 1. And I liked it. That's not a bad idea. We look at 60-minute bars. We don't really look at much more than maybe a 4 or 5 year in sample window. That's probably even too long. But we look at windows anywhere from 5 years by 6 months to we're looking at something probably about 6 or 9 months versus 1 month. Ironically, when we first, this to me is the epitome of irony. when we first built our first version of what became XT99, we built it on S&P data on daily bars, and it was actually built on a 3 month in sample window versus a 1 month out of sample window.
Wow.
And it was great, but that's the S&P, which is really a volatile market. But it was they're way more volatile now than they were then. So I think it's an empirical question, really. But I would stick with the idea of being 10%, 20%, 30% for the in sample window, and your out of sample window really has to do with the frequency of your data, and what how many trades you really can get out of it. Because if you're looking at
if you're not getting any trades and you're out of sync, you've got to match things up with the strategy type to some extent. Sure. This is probably overcomplicating, but could you define the in sample periods by particular regimes or volatility periods and assess it on
if you were able to, yes, you could. I ultimately do think it really comes down. We started doing something that we never did before, because I'm working on an idea to see whether or not the parameters are relatively stable. So ultimately, if you're looking at it this way, if your in sample period has a big run up in it, and then it goes flatline, and then it sells off and kind of starts going sideways, the minute you get rid of the minute that big run up drops off, you got a whole different world. You're looking at a different regime. When you're in a bull market, you have one basic. You have that kind of regime. When you're in congestion, you have that kind of regime. When you're in sideways, you have that kind of regime, and vice versa for a downtrend. So I think in the end, the perfect world would be to say we're in a sideways market, and we're going to build a model that's going to work in a sideways market. And the minute it starts being a sideways market, probably it's not going to work so great. So, but that's where you, I don't, defining regimes is not so easy. That's where I think if in fact Simmons actually did do that, that's an accomplishment. And with the kind of tools that he had, it's probably somewhat easier. And it changes the whole nature of walk forward, because really what you're doing is saying the regime changed. I've got to adjust my window, and I have to monitor the regime of my out of sample window. And when that changes, I got to do something different. So it changes the whole thing entirely. But I do think that in the end, if your regime, let's be obvious, if you built a strategy on a bull regime, and you go bear, you're not going to do so hot. Same thing is true for any major regime change. Dealing with regimes has really got to do with the pace of your strategy. So if you're more long term, the stock market's been. I mean, if you look, we're looking at a sell off here, but if you look at a monthly chart of the S&P, this ain't diddly squat in terms of a sell off. So now I'm not saying it's not going to happen, but it's not there. It's nowhere near any kind of significant sell off when you've been going up like this for so long. Anyway.
Yeah.
So the thing is, but if you're looking at 60-minute bars, your regime shifted. Yeah. So if you're looking at 5-minute bars, you're in a whole different world. So measuring regimes, I think, would be the ultimate. Being able to measure regimes to begin with is valuable, but being able to measure when your regime has changed is even more valuable, because I have a client who maintains they're great at measuring regimes, and I honestly don't know that I really believe them. We're looking at some material, and I say, well, when did it know that the regime changed? He goes, well, it knew right there. I'm thinking, okay, I'll have to see the proof of that. But that's the thing, you're ultimately, he maintained they measured 16 different regimes. And for the life of me, I'm not really sure I could actually come up with
16 regimes.
16 different regimes. So,
well, presumably, Bob, too, you could run walk forward periods over different time periods, different in sample, out of sample periods. You could, I guess, construct different trading strategies that way, and then kind of pick the best of the best, or again run them all in some ensemble approach, or validate robustness through,
That's the easy way. That's the easier way to do it, because you can. That's
yeah.
easy to do. You can do that, and that would be meaningful.
Mm.
So that's ultimately right now one of the things we're doing is there's been so much thanks to our new POTUS, these markets have become really, really choppy. And so one of the things we're looking at, I'm monitoring strategies with a bunch of different risk and target regimes, just because I know that all of them work, and I know that some of them work better now than then, but I know that they all work. So I have to really keep an eye on what's going on and seeing whether or not the this one's better than that one, and that's not
Not
that,
trivial.
it's not trivial. It'd be better to be systematized.
Yeah.
So that's when like real tests, for example, would really be great, because you could systematize it.
Come on, Marsden. Intraday futures trading.
Yes.
We would take all the market off TradeStation. Yeah, I mean, there's an intraday trading strategy as old as the floor itself, which is the opening range breakout. And is that something that's ever had your interest?
Sure.
Yeah.
It
Okay.
works. It's valuable. I mean, I don't use it now, only because I just haven't really ever gotten around to using it again. It's worthwhile. I did a case years ago. I did some cases as an expert witness for some people in Canada, and the guy who was actually the subject of the case was actually a guy who was selling. It was a tax shelter scheme, and he was basically saying that these strategies were worth millions of dollars. And one of the strategies was simply an opening range breakout strategy. And my testimony was, yes, it's a worthwhile strategy, but it's as old as the hills, and it's not worth $1 million. It'll make money, but it's not worth anything like what he's talking about. It's been around. It's public domain. So yeah, it's worth looking at, but you really have to make sure you really have to test it, because I know that we had kind of one of the things that led up to XT99 was actually not really so much an opening range breakout per se, but it kind of defaulted to an opening range breakout because it was so fast, and the parameters were the orders were basically built around they were built with the open, so it worked like a charm. I mean, frankly, I don't know whether they still really work. I can't imagine they really wouldn't. But I it depends how I'm not sure if, for example, it'd be a great thing for day trading, but I think it probably would be worth. It could be of value.
Can I ask you just briefly, Bob, about something we were talking about in our chat before we started recording, and that's just kind of constructing a portfolio with all of these individual strategies. So when one is building futures strategies, I was asking you whether it's preferable to backtest just running a flat test on a single contract and seeing how that single contract works versus running some risk-based position sizing and assuming a larger account size and risking, say, the same dollar amount on every trade, having that equal bet position size every time, irrespective of how, if the stop is bigger, you trade fewer contracts. If the stop is smaller, you trade more contracts. Does that sort of make much of a difference? And do you have a preference as to which way to backtest?
Well, I like to, like I said, I like to just simply test on a fixed number of contracts and seeing how it does overall. Because in the end, if it can't make enough, if it really can't, if it can't make enough money trading one contract in a fixed account size, it's probably not going to do that. It's not going to do that great when you, as I say, blow it up, where you actually use in a positive way, when you actually use variable sizing. Um, I think using variable sizing and testing really adds a level of complexity to it that probably is not worth it. So what we've always done is we've actually built them on a fixed number of contracts over the entire test period, and then we had a tool that actually would add compounding to it and seeing whether or not it survived. Because it's most of the time with a robust strategy, most of the time they'll be okay with it, but not always. And that's what you really kind of have to know that. And that's and that's the reverse of that is that you can, when if you're using compounding in your testing, you can actually have your testing colored by the fact that you could have a fabulous 1 year period out of a 5 year period, and the rest of them can be really mediocre, and that's going to color what it is you're doing. So I don't think there's anything inherently wrong with it, but I think it just adds a level of complexity to the testing in the beginning, because what you're really doing when you do it the way we do it, we want to see whether it works, then we want to see whether it's robust, and then we want to see whether or not it can actually be used with sizing. And there are three different things.
And I guess if you're working on the basis of trading a fixed number of contracts, you're catering to the smallest possible account size too. So you're inclusive of the smaller traders. That you would need to be a larger trader with a larger account to be able to have that equal bet sizing on every contract, because you've got to have on every trade got to have a certain amount of granularity.
I know that when we built Renaissance, we were promised a very significant account size, and we built it to fit that account size. When you're a money manager, you have to adhere to a certain level. It's kind of a conservative level of leverage, and so we built it that way. But it wound up having like 450 strategies on 25 different markets. So that's the thing. You have to know your audience. You have to know if you have to know your audience.
I mean, that sounds like the holy grail, 450 strategies on, what did you say, 25 markets or something?
Well, I realize that, the way we build strategies is really kind of like at this kind of for that kind of goal. Ranger was actually kind of built to mirror. Ranger actually implemented the same kind of process we used to build Renaissance, with actually even taking it quite a bit further. But we wanted to have a lot of different kinds of uncorrelated strategies, and Ranger allows you to actually build a lot of uncorrelated strategies. But if you don't need a lot of strategies, then of course you just pick the one or two that you really want. Your account will do better if you can trade at least 5 or 10 different kinds of markets, and it'll do even better yet if you can trade 5 or 10 different strategies on 10 or 20 different markets, because you just have a lot more diversification, and you can add diversification to that as well by adding like 5-minute and 60-minute and 3-hour bars and so forth, because it depends on the strategy, but ultimately you can do it so that you can have 5-minute ones that are uncorrelated to the 60-minute ones and so forth. So ultimately, I think that I know that one of the things that Renaissance did was, Rentec, was they had a lot of strategies and they traded a lot of markets. And there's a thing, I don't know what it's actually called in statistics, but there's a thing about, I guess it's risk of ruin. The more trades if you have a 55-45 chance of winning, if you have one strategy, you have one risk of ruin of what? Then you have one risk of ruin. But then if you have 10 of those, your risk of ruin goes down quite a bit. It gets to the point where if you have maybe a couple thousand strategies, your risk of ruin is almost non-existent.
Yeah.
So I mean, there's a reason for it, and there's a compelling reason for it.
Well, talking about Rentec and Jim Simons, go back and listen to that show that we did with Greg Zuckerman. Is that right? Oh, I know he gets confused, Zuckerberg and Zuckers. Of course, it's not Zuckerberg. Sorry, Greg. Greg Zuckerman. And at the end of that show, Rich Brennan and I, Wayne philosophical for a good 20 minutes on what we thought, had to be happening under the hood over there. So it's a good listen and a good chat with Greg.
I will listen to him.
So, what are the tools available, Bob, to traders these days? Like, as an equities trader using Real Test, I have this incredible capability to do portfolio-based testing across a bunch of strategies, all inclusive, and I guess just fiddle around with the entire portfolio rather than one strategy at a time. The TradeStation has some built-in tools for portfolio aggregation, but I hear they're not very good. So, how do you go about putting all of these strategies together into a portfolio so you've got some vision of what the combined backtest kind of looks like?
Well, we run them through the Portfolio Analyst Professional from TradeMate. That gives us it doesn't give us the ability to do any kind of real weighting of the strategies, but it tells us what it looks like as a portfolio. And that's the most important thing, is to find whether or not you really want to find whether or not you're actually improving things with your portfolio or not. So that's the first step. So we are developing other avenues for being able to do the sizing dynamically. But I don't think that to what I know, I know that I think NinjaTrader lets you do a lot of stuff like that. I think multi-charts may let you do a lot of stuff with portfolio on the portfolio level. I don't know that for a fact. I mean, the guy I've used as a programmer in the past really knows NinjaTrader really well. So he tells me that it's got a lot of portfolio capabilities, and I trust him on them.
We should explore that.
And I know that program we discussed, Zaro, has, even though it's really not very widely known, it apparently is quite powerful. And for that matter, there's a program, I think it's called Quant Strategy, not the people from SQX. There's another one done by, it's actually a program that runs in R, which is actually, or uses R it's built with R and runs in R, and you can use all the R libraries. It too is very, very powerful, but it's very difficult. The learning curve is very steep. Let's put it that way.
So if there's any experts out there, please put a comment below, reach out to me, send me an email. Let's have a chat about, how you do it and what you use, whether it's NinjaTrader, multi-charts, TradeMate, or other add-ons. Murray Ruggiero used to have, of course, a fantastic add-on to TradeStation, but I believe that has moved on with him. There are some plugins for TradeStation, like multiwalk.net, if you know about that, or things like that. Yeah, reach out. Let's have a chat. I'd like to know more. Help me to get started and explore what the options are in that realm. Bob, can we kind of wrap up by understanding a bit of the offerings on your website? Because you do sell strategies, if you like, but build it up for me from the ground up. So you've got some tools, some kind of template tools that one can optimize around with, and they can, I believe, buy an open or a closed version so they can actually see what's going on under the hood or not, and then plug in additional strategies to that. Or, I don't want to get it wrong. So
sure,
give me the whole spiel.
We offer 3 strategies development tools: Ranger, Cross, and LDR. LDR is kind of like the bastard sister. It's very, very good, but it's rather limited. And there's a reason for that, but it's not particularly. It's not a reason that would really interest most people. But Ranger is the most developed in terms of being able to actually have the broadest possible range of kinds of strategies. Ranger and Cross. So let's talk about those two. Ranger and Cross are both what are called strategies in TradeStation. So it's a class of the kinds of programs that can be written in TradeStation. They're capable of optimizing strategies and generating signals. And with with we that's the with Ranger, you can create your own strategies, or you can buy the, like you refer to them as add-ons. They're strategies that we've actually created with our own process that actually will create signals for people without any. They're ready to go right out of the box. Same thing with Cross. There are additional add-ons for both Cross and Ranger. We call them the makers. Their Ranger Maker it's another class of program in TradeStation called the Trading App. It uses the TradeStation API, and it's a super highly automated, very fast process for running through a large batch of strategies. So with Ranger Maker, we also have a program that comes with it that actually will compile all the research that Ranger Maker runs into a easy to read report, which we then use to take through our robustness testing, which is a program we call it COFA, and it's basically that's a Python program which actually uses TradeMade's Enhanced Walk Forward Optimizer, or EWFO, to run a batch of walk forwards and cluster analyses, and it too results. It produces a report summarizing all this material. So at the end, you start running the process with Ranger Maker. You wind up with a report that summarizes the results of 132 different kinds of strategies: counter trend, with trend, trend neutral, and it breaks them down. It breaks them down individually if you wanted to look at that, which we do. But it also gives you a summary of the overall performance, so you know where you're actually at. And we make our picks, as we call them, from that, and we put them into the COFA program, which is basically runs files that are actually XML files. It's a very simple process. You simply tell it where the TradeStation files are, and it runs the process with EWFO and produces a report telling you at the end what the robustness and performance of each of these individual strategies actually are. And then from there, it's up to you then to make your picks of which ones you want to actually use and put them into production.
Right. Does it help with so before using this COFA project application, just in the Ranger app itself, does that help with the walk forward analysis, or not necessarily, just use the custom TradeStation tools?
Well, you don't have to have Ranger Maker to do our process. Although I would say that if you value your time, you'd probably want to have Ranger Maker, because it's the amount of labor it saves is mind-boggling. Plus, it's a long story, but it's way faster than doing it in TradeStation itself. But you actually could get Ranger. It comes with workspaces which allow you to do optimizations, and then you could run those out. You can make your picks from those and run them through TradeStations and Walk Forward Optimizer. The Ranger will run in multi-charts, but Ranger Maker will not run in multi-charts. There's no correlate for trading apps and for multi-charts.
And it comes with quite an extensive amount of documentation and help that would help people to go through this process, learn how they're building the strategies, and so on.
There's a very detailed manual with all the features that are in Ranger. Then we've got a separate manual that shows people how to walk through our process. And then with there's further documentation with the Ranger Maker and the COFA stuff, which explains it all.
So you could take Ranger Maker open. So that would include all the code that it's using to generate the strategies, and then you could run that on any instrument you liked,
and any time frame you like. Yes.
Yeah.
One thing I forgot to mention: Ranger also includes 4 different proprietary indicators that I created for trend measurement and momentum measurement.
Yeah.
And there uses filters in Ranger, And if you buy Ranger Open, you actually are able to use the indicators in your own strategies if you like as well.
Yeah. Okay. All right. Awesome. So it's really just a fast track, as you call it, a PhD in algo trading. It's fast tracking all of what we've talked about over the last two shows, and enabling someone to just really rapidly start building from the right kind of template and foundation, if you like.
That's correct. And actually, it's ironic because there's a couple of people who actually are relatively young beginning traders have done. They actually bought Ranger and Ranger Maker, and that's just what they're doing. So you really the thing is, there's becoming an algo trader. If you simply started on your own without any real help from anybody, it could be a long road, and it could actually be rather brutal, to be honest with you. One of the things, what really happens with Ranger is somebody referred to it as the difference between Ranger and some of the ones that just use machine learning to go through a bunch of off the shelf rules is that Ranger is curated. We basically have given with Ranger and Cross, we've given you tools that I know work, and all the different kinds of stops and targets and so forth, the processes and the filters, they work. And so you're starting with something which if you learn the rules, will basically produce something that will actually be profitable. So that's you're getting a huge leg up, as opposed to you're not only getting strategies that work, but you're getting the ability to build many different kinds of strategies that work, and you're learning how to see whether a strategy actually is robust, and that's the big difference is that if you start from scratch, you got to figure it all out yourself. You got to find the strategy. You got to figure out how it is you're actually going to actually see whether or not it actually has any merit or not. And that can be a difficult time-consuming process. And most of the time, it doesn't really. People don't really have success with it. That's why it's sort of like you're getting things that work. You're getting a process that actually has been developed by a guy who actually built a lot of strategies that work, and you're learning how to do that. Now, that's not to say I'm not saying any of it's the best that it could possibly be. I think it's pretty damn good.
And full disclosure, I'm not getting anything from Bob here, but I think that people dramatically underestimate the amount of time and money, or the amount of money, if you measure the time gone, that you're going to spend kind of getting up to speed in trading. And if I could go back 10, 20 years, well, and I think like many people, I did spend a lot of money early on various things, but it was all junk. And it took me a long time. And that was before I got into systematic trading. I was a discretionary trader. But as I refined that, and then you refine what sort of quality is and where you can pick and choose who you want to learn from, it ends up being cheap in retrospect, right? It ends up being cheap to get ahead. So I was just going to ask, for the advanced trader, I think you just answered it. You could still take these products and really adapt them to your own strategies or build entirely new things. With this, you could sort of learn from it and develop it any way you wanted.
We can provide a version of Ranger Maker, which is, we call it's unrestricted. And all you have to do is understand how the XML files work, which is it's not rocket science. It's very simple. And you can adapt it to your own strategies, and run our entire process on our entire process on any strategy you want to. We help you with that if you need it, but it's not very difficult. XML is really finicky, and so and the other one uses JSON files, which are equally finicky. So it's completely unforgiving. You have one wrong character, it's not going to work. It's like old-fashioned programming. But once you get the hang of it, I simply reuse the files we have, because the process is the same pretty much for anything. What varies is some things vary. The XML files, you can create your own XML files. There's no rocket, there's no magic to that. So yes, if you want to, you certainly can, and it's not that difficult.
Mm. All right, Bob, I think we've well and truly deep dived over the last 2 sessions, so I really appreciate it. I think that's fantastic. There's a lot for people to chew on, a lot for me to chew on. I'm really appreciating it myself. I imagine if someone wants to get in touch with you, they should visit your website. So do you want to remind us what the address is?
Yes, the website is Pardo, PARDO.space, SPACE. And you can reach me at bob.pardo@pardo.space also.
Cool. All right, Bob. Well, thanks once again. We really appreciate it, and let's stay in touch.
Sure, of course.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.